right, so we are hiding inside today because it is kind of cold outside.
So cold.
I think it was minus 23 when we woke up this morning. So welcome to our living room, and we have an Ask the Expert with Tamara Gossen.
Yes.
And she is a mortgage broker. So
I am.
we have lots of great info to chat about today related to first-time buyers.
Yes.
But before we get started, Tamara, tell us a little bit about yourself.
Yeah, well, thanks for having me. This is fun and nice and warm here instead of outside. I've been in the real estate world, I guess, since about 2014. So seen some real estate side, now some mortgage side. Before that, I worked at a couple different banks and stuff. So a little bit of a view and vantage point from a few directions, which I think kind of helps.
Absolutely, for sure, because you have that experience to draw on. You know what it feels like to be in various aspects of this real estate transaction, right?
Yeah, it's nice to know kind of, because it takes a team, right, to put it all together.
Absolutely.
So to have a bit of understanding from all sides, I think, hopefully helps the process run smoother.
Yeah, absolutely amazing.
Yeah.
Well, thank you for joining us today. So as I mentioned, we kind of wanted to focus today's video on first-time buyers. So it's a lot, right? It's exciting and daunting all at the same time. When it's your first property, you've probably been saving up for a little while and you're ready to make the move and to take the jump, but it's a lot because there's just so much you don't know and so much you haven't experienced yet. So maybe walk us through and maybe I should take a step back. Explain for all of the first-time buyers who might be watching, what does a mortgage broker do, and how is a mortgage broker different from a traditional, let's say, mortgage specialist that you might see or might talk to at a bank?
Yeah, I would say I honestly get that question almost every time I chat with a first-time buyer because they don't know.
Absolutely.
And everybody knows that you can go to your bank.
Yes.
So they like to know kind of what's the difference and what's the options available. A mortgage specialist at the bank basically has access to those banks' products.
Right.
So they can set you up with whatever that specific institution offers. You do have to kind of fit into that one mold a little bit more.
Okay.
So if you're not, the typical client that meets the standard boxes, it might be tougher.
Sure.
A mortgage broker, we kind of have access to everything for, I like to say, almost everybody. So we can go to the banks, but we can also go to mortgage companies.
Okay.
And they are they're very similar to a bank. So they're regulated like the banks. The difference is that they typically only offer mortgages. So they don't have, like a checkings account and an RSP savings account and stuff like that. And usually you can only access them through a mortgage broker.
Okay.
Yeah. And then once we get outside of that, there's alternative lending options, there's private lending options.
Sure.
It's kind of unending.
Yeah, and you can provide access to all of that.
But we can access all of it. So
Great.
it really just gives you the biggest
So you can
amount of choices.
Yeah, you can shop around all those choices, but only deal with one person.
With
you don't
one
have to go
person.
to each individual lender yourself.
No, and you just have to provide all your documents to one person, do
Yeah.
your credit check with one person instead of
Amazing.
going until you find a good option.
Really, that's really important for them to know. I'm guessing now another question would be, how do you know how much you can be approved for, right? And I mean, they have mortgage calculators online, but of course those only give you a really high level idea because it doesn't take into account maybe some debt or other things that might.
Well, and a lot of people don't necessarily realize what they need to put into the calculator.
Sure.
So the calculators can be accurate if you put all your information in properly. And honestly, most people don't even know some of the nuances that are involved in it.
Sure.
So when it comes down to approvals, I mean, it's basically just a bit of a mathematical equation. Income, debts, and then they give you a percentage that they will allow you to have towards like a house debt.
Sure.
So only so much of your household income can go towards your house.
And while we're on that topic, maybe let's talk just briefly about that. What percentage are we talking about? That's sort of a safe
bet.
Yeah.
The very typical standard would be like there's a GDS percentage and a TDS percentage.
Okay.
And it would be 39% and 44%.
Okay.
And again, if we're looking at alternative options, a lot of that stuff goes out the window and there's a lot of variations we can play with.
Okay.
But those would be fairly typical maximums, and we have seen them change over the years. So it can shift.
And so maybe explain a little bit more about what that percentage means in layman's terms for someone.
Yes.
So they're,
Yeah, so your GDS is basically just specifically the house that you want to buy and the debt load that kind of takes into account. And then the TDS is your total household debt load.
Okay.
So that would take into account kind of credit cards,
Sure.
your boat loan, whatever else you might have.
And that percentage can't exceed a certain amount, or you won't be approved.
You won't be approved, right? Because they want to make sure you can make your payments on everything that you have.
Yeah. So if you have an income, but 60% of it is going towards paying debt, then they're not going to give you a mortgage because you've only got 40% left.
Yes. They want to make sure you can eat and feed your dog.
Yeah, which is good. Yeah. Absolutely. Okay. Awesome. And so also, because you have so many options to choose from, how do you determine what kind of a mortgage is best for a first-time buyer?
Yeah, that's going to be a big conversation that you have with your mortgage broker.
Sure.
It's going to depend on your current situation, your current comfort level, because there's different options where the payments can change or the payments stay the same. It's going to depend on future plans, if you think you may or may not break the mortgage before the term is over, if you are planning to buy another place in 2 or 3 years. There's a lot of things to take in, so it's very much a personal conversation to be had. Yeah,
sure. And I just used the word variable, so speaking of that,
yes,
I'm guessing another question related to that you must get all the time, and not just from first-time buyers, but how do you decide whether you want to go with a variable term or a fixed rate?
Yes, again, that is a conversation to have with your broker. I do think it depends a lot on comfort level and understanding of both products.
Sure.
So, a fixed one's pretty simple in the fact that whatever term you agree to, you'll have that payment the whole time.
Sure.
So it won't change, it won't vary, which provides a lot of people with comfort. You can budget for it, which is great. Variables, there's a little bit of more, layers involved. There's variables and adjustable rates.
Sure.
So adjustable rates is actually what most people are thinking of when they hear the term variable, and that is where your payment will change based on
every month.
Variables are a little more complicated because it's a little bit more behind the scenes, and your payments change at certain thresholds.
Sure.
So and your principal and interest and
There's a bit more, let's say, risk involved there that they have to be comfortable with.
Yes. And you have to just kind of, I think, understand it and be okay with it. They can be a fantastic product, but I do like to make sure people have a good grasp on what goes along with it.
That makes sense. And as a first-time buyer, you want to make sure that you're, going to be really comfortable with it.
Yeah, you don't want to not sleep at night because your mortgage payments.
For sure.
Doing something funny.
For sure. So along those lines, what are the terms and conditions of a mortgage rate? Because I'm assuming that, certain, like the rates will vary depending on, obviously if you choose between variable and fixed, but also if the term will affect the rate as well.
The term can affect the rate. So you can choose different term lengths. You can even have an open mortgage, which has no term attached to it. You're still signed up for a certain window of time, but it just gives you the ultimate flexibility. And typically people will sign up for 1 to 5 years, with 5 being kind of super, super average, super normal. But there is longer terms available too. And they kind of all come with different fine print and expectations.
And so you're there to help understand.
Yeah. And we always like to make sure that people do have a good understanding of the fine print.
Sure.
Because I think a lot of people think, oh, it's a mortgage, I make payments. That's kind of the end of the story.
Exactly.
And sometimes it's that simple, but sometimes, there's lots of little things that go along with it. So
sure, not all mortgage products are the same, right?
No.
And so, I try to explain to my clients as well, like just because one says no doesn't mean they're all going to say no, because they all have different rules around lending and different options available for lending as well, right?
Yeah, they depending on the times, have a little bit of a different appetite on what they'll accept. And
that makes complete sense.
Yeah.
Okay. And how long I always bug my clients to get a pre-approval, and especially important for first-time buyers when they really might not have any idea of what they're going in with. So maybe tell us a little bit about how that pre-approval process can work and how long can you get a rate locked in for?
Right. So with a pre-approval, we go through kind of everything. It's just the best way to know what you actually can afford, what you're going to pre-approve for when you find that house that you love and you want.
Yeah.
Because a lot of people, again, with those calculators, will put in, their income and different things. But if you're putting in a bonus from your T4 last year, it may or may not be valid when it comes to actually getting approved for a house.
Sure.
So we go through all the paperwork. We go through your pay stubs. We go through letters of employment, maybe T4s, maybe tax documents. It depends on your employment and pay structures. And we look at, like bank statements for your down payments. We do a credit check. And it just kind of lets us debt service and make sure we have the full picture so that then the client is confident going out. This is what I'm going to get approved for and it's going to work.
Absolutely.
Yeah. And then it's going to be a lot less stress come applying for your mortgage.
Yes. And then explain, if you can, a little bit more about a rate hold that you can get with your pre-approval as well and how that works.
Yeah. So the rate holds typically are about 120 days.
Okay.
And it just kind of guarantees you a worst case scenario on an interest rate.
Okay.
So we have a few places that'll let us do them. And we just get it locked in. If rates go up and you buy within that, you have to take possession within that 120-day window, then you'll still get that interest rate.
Sure.
And if rates go down, bonus, then we'll just apply for a lower rate for you.
Okay.
Yeah.
Amazing.
Yeah.
So especially, lately when rates have been changing so much, I think that would be important for someone to just give you a little bit of peace of mind knowing that you're locked in for that period of time.
Yeah. And if it expires, then we just do it again and check if there's any updated information. So if it takes you a year to find a place, we'll just we'll keep updating. But
perfect. So another question that comes to mind is, what are some fees that are associated with a mortgage? Like, for example, appraisal or something along those lines. What should a buyer, a first-time buyer especially, plan for and save for so they're not caught off guard with some of these extras?
And there's a few little things. They're not too bad. There's things like you said, like appraisals, home inspections, condo doc reviews might come up. There's the legal fees to close the mortgage and get the title transferred and all that. So, a few $1,000s probably is a good amount to budget for. I always think we're so lucky in Alberta that we don't have some of the really, really big fees like some of the other provinces and land transfer taxes and stuff. So it's quite affordable and reasonable here.
I know Ontario and BC are a little crazy.
It's mind-blowing to me to think that just to transfer the title might cost you $10,000, $20,000, $30,000.
Yeah, absolutely.
Yeah.
So something like an appraisal, is that always charged back to the buyer, or are there cases where the lender will cover that?
There can be.
Okay.
Yeah. So again, it just depends on the reason for the appraisal. Sometimes it might depend on the lender that we choose. It really might change throughout the year. Like they might offer a couple months of, paying for the appraisal to get a bit more business. Definitely not a guarantee and definitely an expense to kind of have available if need be.
Sure.
But they're not even always ordered. So it's just something you won't know until that point.
Yeah, absolutely. No, good.
Yeah.
What about mortgage insurance and when does mortgage insurance come into play and what should people expect? Maybe just tell us a little bit about how that works.
Yeah, well, there's a few options. So you'll always be required to have fire insurance. So that is just the insurance on your house in case the house burns down or your sinks flood or whatever, your typical home insurance. Yeah. So you will be required to have that in place to prove to the lawyer before you get the house.
Sure.
So that's standard. There's a few options for mortgage insurance. They're all kind of optional. So I always recommend people have their debts covered somehow in case something happens or some kind of income replacement you might need. But you can have it directly tied to your mortgage so that as your mortgage is paid down, you just pay your premium every month. You can have like an extra life insurance policy so that if something happens to you, you can use those funds then to pay off your mortgage. So definitely a few options. And we work with a few referral partners just to kind of provide that advice and those options to make sure you choose what product is best suited for your needs.
Sure.
Yeah.
Okay. And then related to insurance, let's talk about, a lot of first-time buyers, they don't have 20% to put down. So, they're probably only putting, in most cases, 5, 10, if they're lucky, 15% down.
Right.
And so walk us through what that means, because there are some extra fees involved.
Right. So if you are under 20% down, you have to have, most people would know of it as CMHC insurance. There is a couple other insurers as well.
Right.
But it's a premium that's actually just attached directly onto your mortgage.
Right.
So when you get, again, your letter from the lender saying, we'll give you a mortgage, here's your rate, here's your conditions, it'll show your premium on there.
Right.
And like I said, it just kind of increases your mortgage by a few $1,000s, and then your payments are based off of that amount.
Okay.
So if you sell the house, you just kind of have to pay off the whole amount. But you don't, it's there, but it's very much in the background and not something you need to kind of worry about or be paying separately.
Okay. And maybe explain, why is it necessary? I mean, why do buyers have to pay that extra premium when they're putting less money down?
It kind of is just a bit of a risk tolerance.
Okay.
So you have less investment personally in the home.
Okay.
So the government kind of came up with this policy or product to allow for a lower down payment.
Okay.
So it just kind of offsets if you don't have the 20% down.
Okay.
You can still buy a house. You got a little bit of insurance there just in case things go sideways, that investment is then protected for the lenders.
Okay.
So the lenders are willing to lend with minimal investment from yourself.
Okay. No, that makes complete sense. So let's go back a little bit when we were talking about the types of terms. How does a term of the mortgage affect monthly payments and interest? So, if someone's thinking about, most people might go for a 5-year term, for example, but there are other options available.
Yeah.
Maybe let's talk briefly a little bit about how that can affect, how the term can affect that.
So basically your term is what you've agreed to with the lender for a length of time. So it could be 6 months, it could be up to like 10 years. And all the terms and conditions of your mortgage are in place for that term.
Right.
So if you have a fixed rate, that's going to be your payment for the length of the term. If you have an adjustable rate, it's going to vary with the interest rates in Canada. And your rate will be based off of that rate plus or minus whatever the lender has agreed to.
Right.
So there's like the prime rate.
Yes.
And then the lender will say, we'll give you a mortgage at the prime rate minus 0.5. Okay. So for the term, you will always pay minus 0.5.
Okay.
And then, so you can kind of negotiate and check into options at the end of the term.
Okay.
Yeah.
Gotcha.
And then there's penalties if you break the term.
Right. And what do those penalties typically look like?
Yeah, again, those are all over the place.
Yeah, okay.
With the adjustable rates, they are more flexible. Like they're typically a 3-month payout penalty.
Okay.
So it is usually less. With the fixed rates, it's just a giant formula, and it's going to depend if interest rates have gone up or down from the time you got your mortgage.
Okay.
So it could be 3 months interest, and it could be substantially higher.
Right.
And the banks typically have a higher risk of a higher penalty.
Sure, because they're looking at this going, okay, we were expecting to receive X amount in interest, and now you're breaking it early, so we're not receiving that money.
Well, and the banks give you typically, like the rate that you pay isn't the rate that's in your contract.
Right.
So they actually discount it in your contract, but then they can do the penalty calculation off of the contract rate.
Okay.
So there is a higher risk factor there of payout penalties. Yeah.
Okay, gotcha.
Yeah.
So it's important that when you think about the term that you want to lock into, as you
Yeah.
alluded to earlier, you really want to think about as much as you can.
Yes.
It's hard to know sometimes where you're going to be in 3 or 4 or 5 years, but to really have a good think about that, because you know you don't want to lock yourself in and then find yourself with all these big penalties.
Yeah, you don't want to have to pay $30,000 in fees. You
Absolutely.
Yeah.
Okay, no, that's good to know. And then amortization. So
Yes.
let's talk a little bit about that.
Yeah.
How that relates to how it's different from a term and how it relates to it.
Yeah, so the amortization is basically the expected amount or agreed upon amount of time to pay off the entire mortgage.
Right.
So even if you have a 5-year term, obviously you're not paying it off in 5 years typically, but the payments will be based on those details, paying it off over 25 years.
Okay.
Yeah.
Okay.
So most are 25. Again, if we get into 20% down, we can look at 30, maybe 35-year amortizations. And again, this can all kind of be somewhat renegotiated at renewal, or it'll depend on a few things, but yeah.
Sure. Okay, that makes sense. So in order to buy, obviously, you're going to need some kind of a down payment.
Yeah.
What's typical? I mean, we kind of alluded to it before. I think most first-time buyers especially are probably coming into it with 5% down. Hopefully, they've got a little bit more. What is the minimum? What does that look like?
Yeah, so I mean, minimum is 5%. It can be kind of gifted money from a family member, like a direct family member. There's some rules around gifting.
Okay.
They often do also look at closing costs.
Okay.
So you have to have minimum 5% down, but you also have to prove that you have the ability to close on the mortgage.
Okay.
So they're going to look for a few extra $1,000 in your bank account just to make sure you can pay the lawyer's fees and anything else that might be due at the time of closing.
Can you take out a loan for a down payment?
Yes and no.
Okay.
There's very few small instances where you can kind of borrow funds for it.
Okay.
It doesn't apply to very many clients.
Okay.
And it's very difficult to get done.
Gotcha.
Yeah.
So and I'm guessing using a credit card, does that fall into a similar, can you slap down your card and take some money off on your card for your down payment?
Yes and no. Not like directly really at the time of closing, but there is ways if you have access to credit that we can, if we're talking to you far enough ahead of time and you have access to, say, a line of credit for some reason, you can take that money out and hold it for a few months and then maybe use that towards a down payment.
Okay.
I do think for first-time buyers, it's a good idea to have had the ability to save it up.
Sure.
So
absolutely.
Yeah.
And you mentioned holding it for a few months. So tell us a little bit more about that, because I've run into this with clients before, and I think it's really important for everyone to understand.
To know.
And then on that part B, is a gift from a parent, does it fall under the same sort of wait time?
Right. Mm-hmm. So down payments, we typically have to prove the source for 90 days.
Okay.
So we're going to be looking at like your bank statements, your RSP account, TFSA, wherever the money's coming from.
Right.
And we need to see that it's been in your possession for the last 90 days.
Right.
Now, there can be instances where, let's say you had a boat and you sold that and want to put it towards a house. That's no problem. We just need to see like a bill of sale and the funds going into your account. And that proves that 90-day ownership.
Yes.
So when we ask for bank statements, we're not just being like Snoopy and seeing what you spent on the weekend. It is a regulation that we do have to do in order to avoid like money laundering and stuff like that.
Yeah. Well, the case I had, the buyer, her sister was helping her as a gift with a down payment and sent the money from overseas, and she didn't have it long enough in her account, and we were really, really scrambling to figure that out.
Yeah, and that one can get tricky, and it depends too where the money's coming from. Different countries are treated differently.
Sure.
It depends on the size of the down payment. So if you have a parent just sending, $5,000 or $10,000, we probably just need a letter saying that you're giving this money to your child.
Sure.
If you're sending $120,000, the lenders might actually ask then for like the parent's bank statements.
Gotcha.
So it could get a lot more invasive into the gifter's funds.
Sure.
And again, every lender has their own threshold and rules kind of surrounding it.
Yep.
But yeah.
Okay.
Yeah.
So while we're talking about help from parents for the down payment, let's talk about co-signing, because I have run into this, especially with first-time buyers, where we've gone in and the first-time buyer thinks that they can kind of do this on their own, and then it comes down to no, we need somebody to help you with this. So tell us a little bit about how co-signing can work.
Yeah, I mean, ideally, it's always a direct family member, because in the lender's eyes, if you just like go to your buddy from your biology class and he's like, yeah, dude, I'll sign your papers, that's great. But he really has no personal concern if things go sideways on the house.
Sure.
So if we're looking at co-signers, we do like it to be somebody close and somewhat invested themselves. They don't have to live in the house, but they do prefer that they have kind of a personal interest and attachment to the place.
Sure.
So we can certainly look at that. The co-signers just have to be able to kind of debt service their debts. So it becomes, again, a formula. All of the income on the new purchase plus all of the debts that anybody on the file has.
Sure.
And it all has to work.
Absolutely.
Yeah.
So if the co-signer also has a mortgage, then that has to be taken into
Yeah,
account.
yeah,
But
exactly.
then their income can too.
Yes.
Yeah. Okay. Yeah, it's definitely saved a few of my deals in the
Yeah.
past. You know, and I get it. You know, as a first-time buyer, you really want to try to do it on your own, but just sometimes it's not possible, and you just need that little extra bit of help.
Yeah,
So
and if it's an option, it can be wonderful.
It was the same, you know. So,
yeah, and we can, again, like once you can afford it by yourself, then we can change title and do some things to get it
So
back
you
into
can
your
remove
name.
the
Yeah.
Okay, great. That's
Yeah,
good
so it
to-
doesn't have to be a lifelong commitment.
For sure.
Just until the numbers work.
Absolutely.
Yeah.
Okay, great. So first-time buyer programs. So let's stay on that theme of help from outside sources. So tell us a little bit about the existing first-time buyer programs and also what we hear is coming.
Yeah. So there's kind of two main ones currently. So there is the home buyers program, which is kind of a tax-free withdrawal from your RSP account.
Okay.
So you would already have the funds saved up. It just allows you to withdraw that money without having to pay taxes at the time of withdrawing it.
Wonderful.
So you
And
can
what's
use-
that amount that you
The max is $35,000.
Okay.
Yeah, so you can kind of take that directly one for one and put it towards the house, which is great. And then it has to be repaid in 15 years.
Okay.
Yeah.
And if there are two people purchasing, let's say boyfriend and girlfriend are buying a place together, do they each qualify for that 35
They
individually
each-
so that they
yes.
can get 70?
So it has to be their own separate, like their names have to be on the
Sure.
accounts.
Yep.
And they both have to be considered first-time buyers.
Yep.
So there is some rules that you have to meet to be a first-time buyer, but yes,
Okay.
they both can.
Wonderful.
Yeah.
Okay. And you mentioned a second program.
Yeah, so there's a first-time home buyers incentive program.
Okay.
And so that is extra down payment that the government will basically give you towards your house.
Okay.
So you have to have your minimum amount and then they will match it.
Oh, wow.
Yeah. So it can help. It can help lower monthly payments. It can get you into a place that maybe you were just like a little bit not quite qualified for.
Okay.
They do have then part ownership in your house.
Sure. So instead of going
Yeah.
to mom and dad,
Yeah.
you're going to the government. And so I guess, can you think of it like a co-signer in a way? Where
Maybe a little bit. Like
little
they
bit,
kind
yeah.
of, they own like 5 or 10% of your house, depending on what you get.
Yep.
And then you either have to repay it in 25 years or the time you sell your house.
Okay, and then when you
Yeah.
sell, I'm guessing
Yes.
if you make money, that they're going to take
Yes.
a little bit of that profit. Is that correct?
Yeah. So they've made some updates to that. So
Okay.
now they have maxed it for gains and losses.
Okay, I was
So
going to say
it's-
then the losses. Do they
Yes.
also help? Oh, yeah.
Yes.
Okay.
So it's a 8% per year
Okay.
gain or loss.
Okay.
So they'll just run a formula when you sell the house and they'll look at how much you were given and then, the current value of the home. And then that will just have to, at the time of paying off the mortgage and everything that goes along with the house, it'll get dispersed back.
Okay.
Yeah.
Wonderful. And rumor had it that there was another program kind of
Yes.
in the works. Do you
So
know much
we're
about that?
hoping 2023. I
Okay.
don't think there's an official date as of yet.
Okay.
But yeah, there's talk of kind of an RSP meets TFSA type program.
Okay.
So I think it could be great. It will let you put in, from my understanding, tax-free money into your account and then take it out tax-free.
Okay, into a TFSA instead of using your RSPs. Is that
Well, you can put it in, when you put money into RSP, it goes in tax-free.
okay?
So you can do that into this new home buyer's savings account.
Okay,
And then when you take it out, it's like a TFSA. You don't have to pay tax on
Yeah.
it.
Okay.
Yeah. So it'll
Wonderful.
be a maximum per year. I think we're expecting about 8,000 per year to a maximum of 40.
Okay.
Yeah. But if you're using it towards buying a house, I think it could be a really good option. Yeah.
Absolutely. Tax-free
Yeah.
money is
Yeah.
always a good thing for
Take
sure.
it. Yeah.
I think that's kind of all the questions I had. Do you think have I missed anything that you think would be important to kind of cover for
I
first-time
think
buyers?
we've covered it a lot. I just think for first-time buyers, it's a good idea to find the people that you want to work with and trust and just spend a half hour chatting. If they have questions, making sure they have a good understanding of the process and what to expect and just kind of get the groundwork laid because it's super, super exciting, but it can be really overwhelming.
Absolutely. Overwhelming, scary.
Yeah.
I mean, so many emotions.
It's all the emotions.
And you're right. I mean, having someone just to kind of hold your hand through it,
Yeah.
right?
Well, and they don't have to know everything. That's why
Right.
there are people here like us that are licensed to help.
Sure.
It's my job to know these details.
Yes.
And for me just to explain it to you and help you make a decision on what's best.
Sure.
But it's not your job to know it all.
Absolutely.
So find someone you trust and then you can work from there.
Great parting
Yeah.
words. Thank you so much
Yes,
for all of
thanks.
this great information. I hope that you have found this video to be helpful. As always, please like this video and remember to subscribe to our channel so you can be updated when new ones launch every week. Thanks again for tuning in. Thanks, Tamara.
Thanks.
Have a good day.